A profit arising out of sale of a capital asset is called as capital gain. So what is a capital asset? It is a property which is held by an assessee. It may or may not be used by him for his business. These are those assets which are not considered as capital asset. Any stock in trade which is used by assessee for his own business is not considered as capital asset. Any profit arising out of stock in trade is a business profit. Second, any asset which is having a personal effect on assessee, then it is not considered as capital asset. Example, furniture, wearing apparels, and so on. It doesn't include jewelry. An agricultural land which is used for agricultural purpose is not a capital asset. These bonds, 6.5% gold bonds, 7% gold bonds, or National Defense Fund gold bonds, special bearer bonds, gold deposit bonds are not considered as capital asset. Asset is of two types. One is short-term capital asset and another one is long-term capital asset. An asset which is held for less than 36 months is called as short-term capital asset. An asset which is held for more than 36 months is called as long-term capital asset. In case of shares and debentures, it is 12 months. Method of computing short-term capital gain. First, take sales consideration, that is purchase price. From that, deduct cost of expenditure on sales. You will get net consideration. From net consideration, deduct cost of acquisition and cost of improvement. The balance which you get is called as short-term capital gain or short-term capital loss. For computing long-term capital gain, it is as similar as computing short-term capital gain. You have to take the sales price. From that, you have to deduct expenses on sales. You will get net consideration. From net consideration, instead of deducting cost of acquisition, you have to deduct index cost of acquisition. Instead of deducting cost of improvement, you have to deduct indexed cost of improvement. The balance which you get is called as long-term capital gain or long-term capital loss. How to calculate index cost of acquisition if the asset is acquired before 1/4/2001. Take cost price or fair market value, whichever is highest. Multiply it with cost of inflation index for the year of sales divided by cost of inflation index for the year 2001-2002, that is 100. Capital assets acquired after 1/4/2001. Cost of acquisition into cost of inflation index for the year of sales divided by cost of inflation index for the year of transfer. If the long-term capital asset is acquired by the present seller after 1/4/2001 but was acquired by the previous owner before 1/4/2001, mostly this will be in the cases of will, gift, so on. So for calculating that index cost of acquisition, you have to use this formula: cost or fair market value, whichever is highest, multiplied by cost of inflation index for the year of sales divided by cost of inflation index for the year on which the present seller becomes the owner. To calculate index cost of improvement, take cost of improvement, multiply it with cost of inflation index for the year of transfer divided by cost of inflation index for the year of improvement. Section 50D, if it is not accessible the actual acquisition cost, then you can treat the fair market value as the cost of acquisition at that time. If conversion of capital asset is taking place into stock in trade, the date on the conversion of capital asset is treated as transfer of capital asset, and when the stock in trade is sold in the market, it will be treated as business profit. After calculating the long-term capital gain, the assessee is eligible for exemption under section 54. The exemption is capital gain from the transfer of residential house property. The long-term capital gain should have occurred because of transfer of an residential house property, which should be invested in another residential house property in a stipulated time. Exemption under section 54B is available for transferring an agricultural land and purchasing another agricultural land within a stipulated time. Section 54D is applicable for compulsory acquisition of assets, and the long-term capital gain arising out of that is invested in another land or building. Exemption under section 54EC, it is invested within 6 months in a specified assets under section 54EC and it should not be sold within 3 years. Exemption under section 54F is available for long-term capital gain other than transfer of residential house. It is invested in another residential house property. Exemption is calculated with the proportionate formula: amount invested into long-term capital gain divided by net consideration. If amount invested is more than the net consideration, full capital gain is exempted. Exemption under section 54G, it is applicable for both for short-term capital gain and long-term capital gain. It is invested in another land and building or plant and machinery within a stipulated time. Thank you.